The lecture opens by framing how tax policy shapes economic outcomes, linking fiscal rules to investment, work incentives, and growth. This slide sets the stage for a practical tour of mechanisms and evidence, showing how policy choices ripple through the economy and why careful design matters for long-run productivity and wages. This slide traces the main transmission channels through which tax policy operates, from labor supply incentives and human capital accumulation to capital formation, R&D effort and resource allocation. The visual diagram helps explain why poorly designed levies raise hurdle rates, delay projects, and divert activity abroad, creating avoidable barriers to growth if left unchecked. Here we look at empirical evidence on top rate thresholds and growth dynamics, where the graphs suggest top marginal rates above about 50% are associated with slower GDP growth. The slide summarizes an estimated effect that a 10 percentage point cut can boost annual real growth by around 0.3 percentage points, and also shifts income and tax shares toward upper brackets. This slide compares depreciation regimes and their effects on capital investment, contrasting multi-year write-offs with full expensing. Multi-year write-offs lift current year tax burdens and can slow capital formation, while immediate expensing lowers the after-tax price of capital, encouraging faster investment, more jobs, and greater economic activity, as the icons and flow arrows illustrate. The capital gains slide contrasts elevated and lower tax rates and their implications for investment channels. High rates compress net investor returns and can choke off equity finance for young, innovative firms, while lower rates tend to channel savings into higher productivity projects and speed technological diffusion, improving capital allocation, efficiency, and long-run growth. This slide explains how tightening interest deductibility raises the after-tax cost of debt and changes financial incentives. The flow diagram shows that limits on deductibility discourage leveraged investment and infrastructure projects, trim future capital stock, and ultimately reduce long-term growth potential unless other supportive measures compensate for the effect. The focus here is on how tax preferences skew investment allocation, using preferential housing treatment as an example that diverts savings away from productive business assets. The proposed shift toward asset neutrality aims to unlock balanced investment across asset types, boosting aggregate output and welfare by leveling the playing field for productive capital. This slide outlines the crowding out dynamics when rate cuts are financed by debt. Government borrowing near full employment can siphon private saving and lift interest rates, which raises borrowing costs and leads businesses to delay domestic investment, muting the intended supplier-side gains and highlighting the importance of funding strategy and tax reform. The next slide unpacks the equity narratives around top rate reductions, showing a nuanced paradox. Cutting top rates can raise visible earnings and reduce avoidance, but measured income dispersion may widen, even as high earners pay a larger share of total tax. The takeaway is that distributional outcomes depend on behavioral responses and measurement choices. This slide lays out 5 policy pillars for a growth-friendly tax reform: lower statutory rates, broader bases, full expensing for capital and R&D, competitive capital gains treatment, and neutralizing asset-specific biases. Together, these elements are presented as a coherent framework to lift productivity, encourage innovation, and raise wages across the economy. Here we cover 3 strategies for sustainable tax policy. Combine rate changes with base broadening to preserve fiscal balance and avoid persistent deficits. Use dynamic scoring to capture economic feedbacks and refine policy, and sequence reforms carefully to safeguard debt sustainability while delivering long-run gains in output and resilience. The final content slide presents the policy alignment cycle as a continuous process. Set long-run expansion goals, target near-term outcomes, continually review rules like depreciation and interest regulations, and iterate based on evidence. The message is that effective tax policy requires ongoing alignment, monitoring, and adjustment to sustain growth and meet policy objectives.